Hi, everybody. Mike Riley of Gaining Altitude Financial here with you. And today we're going to cover off what is the best portfolio. I often get asked by clients or potential clients about what should I really be investing in, what's the best portfolio that you can put together for me. And it's often like asking what's the best tool, a hammer or a pair of pliers. They are both excellent tools, but they do different things. I would not use a pair of pliers to hang a picture, and I would not use a hammer to tighten anything. That's very much true for investment portfolios. And we're going to talk specifically here about mutual funds or segregated funds. And if you'd like to know what's in those, there's another video that you can get here on the YouTube page. What's in a mutual fund is what it's called, and that talks about that. But if you're doing your own investing, putting things together with your own stocks and or bonds, the percentages that I'm going to talk about today are very similar. So if you're able to manage that and know what composition is inside the portfolio that you're putting together, this should also still work for you. So the question is, the best portfolio really depends on a number of factors, the most important of which is time. That is, how long are you willing to leave the money invested for the market to do whatever the market's going to do. The market's going to do this. It goes up and down. It has always done that since the investment markets began. If your time frame is long enough from beginning to end, you're going to have more money at the end than you did at the beginning, but there are going to be dips and peaks in between where you may be taking money out at a loss if your time frame is not specific. So how long you have is one thing, and what's your risk tolerance is the other question. If you're someone who lies awake night worrying that you're going to lose all your money or that you've lost any money, and I've got a whole video about whether you actually did lose money or not that I would refer you to. But for my clients, I know being able to sleep at night is important. So depending on your risk tolerance, that may determine what kind of a portfolio allocation you have. But knowing those two things, let's go back to time. And there's basically 5 main portfolio compositions that I would recommend, and they're all time-based, and they're a mix of a percentage of fixed income, which are those instruments which are like bonds and other debt instruments, mortgage funds, that you have loaned somebody money and they're going to pay you back at a certain percentage, and equity, which is just ownership of shares in something. And we're not going to talk about necessarily what that equity is in this video. I have other ones about that, but if you'd like to know specifically, please send me a direct message. But so the first is, let's talk about time. So if you're purchasing something in the next 6 months, whether it's a vehicle, your kid's education, a down payment for a home, you really should be in cash because we don't know what's going to happen over the next 6 months. If the market takes off, you might have lost out on a few percentage points. If it goes down, your money is going to be worth less. So I don't want people to be in a position of, I've got $20,000 that I want to buy something with, and now I've only got $19,000 because the market went down. So over the next 6 months, just have your money in cash, set it aside in a separate account, and then you don't need to worry about it. But let's look beyond 6 months. So 6 months to a year and a half to 2 years, you're looking to make an investment. You want to at least keep pace with inflation and have a little bit of growth. Then a conservative portfolio is something that would be good for you. So let's say that's 6 months to 2 years. If your risk tolerance is a little higher, maybe if it's as far as 2 years, you could look at something a little bit more aggressive, but let's put that on the back burner for now. This is something you want to be able to at least beat inflation, so maybe you get 2 to 3% on average per year over 10 years. So over a 10-year time frame, the average would be 2 to 3%. Some years it's going to be less, some years it's going to be more, but 2 to 3 is pretty much what you can count on in a conservative. And what we have here is 20% equity and 80% fixed income. So the red is equity, the blue is fixed income. So it's mostly things like mortgages and bonds and a little wedge of equity just to try and put some juice into it so that you can outpace inflation. Not very sexy, but you don't need to worry about anything. So that's the conservative. So now we say, okay, well, my time frame is around 2 years, maybe 3, maybe 4 years, because we are in the market for buying a house or a recreational property, or my kids are in high school now or just about to graduate, but maybe they're going to take a year off. So now we're looking at 2 to 4 years, and that looks like a moderate portfolio. A moderate portfolio is now 40% equity and 60% fixed income. So the equity wedge has come up, the fixed income wedge has gone down. And on this one, you could look at anywhere from 3 to 5% annual rate of return. Yeah, maybe 5 is a little generous. Let's say 4. Don't want to overpromise. Again, over a 10-year period, on average, 3 to 4% rate of return. You're going to exceed inflation, so you get a little bit of growth. And but some years it's going to be up, some years it's going to be down. But over that 10 years, that's kind of what most portfolios are producing. So now we say, well, I'm okay. I want to invest for more than 4 years, 4 to 6, maybe 4 to 7. Maybe I'm not that risk. I don't want to take on a lot of risk. Balanced portfolios are terrific. I have my kids' education in a balanced portfolio. They tend to do very well with volatility. They are now 60% equity and 40% fixed income. So that's the balanced. And we're looking at 4 years to, let's say, 7 years. And I'm seeing 5 to 7% on average. And this is after fees over a 10-year period, anywhere in there, a balanced one. Some have been outperforming when the markets came back after COVID. The balanced funds were doing very well. Again, we're still looking fairly short term, so less than 7 years, a balanced fund. Or if your time frame is longer than 7 years, and you're the sort of person who I was saying sleeping at night is a challenge, or you just want to get started and see how you feel, we can always move up and say, I'm looking at more than 7 years, so 7 to 15 years. Then an advanced portfolio would be a good mix, and that's 80% equity and 20% fixed income. So now it's the reverse of the conservative. So 7 to 9% on average over a 10-year period. Some years is going to be up, some years is going to be down, but that's not unreasonable to think about 7 to 15 years. My retirement funds some of it is in an advanced portfolio. And if you have more than 15 years, you're not going to touch this money, you can let it ride, then an aggressive portfolio that's 100% equity. And we can do all kinds of different things inside that. So that's 9% plus on average over a 10-year period. So that's where I would see things. And you can always move up and down. You can have different slivers of a portfolio in different things depending on your time frame. I recommend managed portfolios. And again, I'm not speaking to if you're managing your own stuff, buying and selling, and you're happy doing it, you get a kick out of it. Keep doing that. If it's something where you want to be able to put the money in and not think about it because you're focused on the rest of your life, I highly recommend a managed portfolio for the specific reason that if you're in a balanced portfolio, for example, and you have a great year where the equities have outperformed the fixed income, what happens is it becomes out of balance, and the equity might go up to 65% equity and only 35% fixed income. So then it has to be rebalanced. And with a managed portfolio, it happens automatically. You don't have to think about when it's going to be. There's no emotion involved to try and time the market to sell off this wedge of the 5% and buy back into the equity. Or it could go the other way in a year that the advanced portfolio, that the equities have done poorly or they've been outperformed by the fixed income, and now that's at 25%. Let the professional managers sell off that 5% and then buy in at the bottom. So with a managed portfolio, you are getting that buying high and selling low, which is the mantra for investing, but seems to be so difficult for many people to do. So that is a long answer on what's the best portfolio. It just depends on what you're looking for, what your time frame is, what's happening in your life, what are the things that you're expecting to have happen. And once you know those things, then it's easy to make decisions. If you'd like to know more about that, please reach out to me. Please subscribe to the YouTube channel here so you can get more information, and let me know what other topics you'd like me to cover up. So Mike Riley, Gaining Altitude Financial, helping you gain altitude and gain confidence.